Hey everyone, I wanted to do a quick video on Sanity checking your strikes and expirations using my ATR levels. I think this is a question a lot of folks have who are starting out trading. Which strike do I pick? Which expiration do I pick? There are no perfect answers to this, but using probability and statistics can kind of help you make sure you don't get into a difficult situation. Before we begin the presentation, I just want to let you know and remind you that this presentation is not financial advice, and I'm not a financial advisor. So any ideas or thoughts that I express here that lead to any trades you might take, those trades are your trades and your trades alone. With that, let's get started with the presentation. All right, so I wanted to do a quick video on Sanity checking strikes and expirations. I think this is probably something that people wonder about a lot. If you're taking alerts, usually the folks that you're taking alerts off will have a strike selection. Sometimes it'll be, closer to the money. Sometimes it'll be further out. There's different styles and different methodologies for trading. Typically, the further out of the money, it's going to be more risky. And the closer to the money or at the money or in the money, it's going to be slightly less risky. Because there's still some intrinsic value in the contract if you're in the money. And so, but if you're selecting out of the money strikes, how do you know what is possible or what is probable? And I think ATR levels can really help with that. Let's focus in really quick on let's say AMD. So I've got the AMD chart from Friday pulled up, and as we know, we had a decline in the market, a pretty serious decline after the previous day's sell-off due to CPI. And so, you're watching pre-market, you've got ATR levels up, it's rejecting the call trigger. That's a pretty clear sign that we're probably, and it's below this bearish ribbon, a pretty clear sign that we'll probably have a good short here. And so, let's say we open, this is the previous close. So we're opening up roughly at the previous close after rising a little bit in the pre-market and then selling off. And the ribbon is already bearish here, so we're rejected at the 21 and then declining. So let's say you decide to get into the trade there at the rejection of support and the ribbon. That's a good entry. Maybe you want to be safer and you enter at the put trigger, right? Or when it breaks pre-market lows. Those are all valid entries on this. It's really just dependent on your risk profile and where you like to enter the trade. But let's say we want to get in. So what's a good strike? You might ask yourself. Well, if you want to keep it closer to the money, you could get a strike at, let's say, 99. That's the previous close. So you could say 99 strike, and that would be perfectly fine. Let's say you think it's going to decline further and you want to buy something out of the money. You could buy, let's say you're entering here. You could buy, let's say, the 90. Let's look at the chain here. Let's see what we got. We're actually going to look at next week's. So you got a 97.50. So, going back to our chart. Yeah, that would work. So 97.50 at the money, slightly out of the money. If you're entering, let's say here, or entering at the rejection of the previous close, or entering at, this pre-market support. 97.50 slightly out of the money. You hit it, it goes in the money. That's going to be pretty decent. Let's say you feel like, oh no, it's going to be a big sell-off today. I feel like I can get a little bit more out of the money. The next strike I might look at is looking at our mid-range level, which is 95. You could look at the 95 strike, which of course now is in the money, but at the time of the trade, it was out of money. It's pretty far out of the money, actually. Not terribly far, but a couple of dollars out, right? A couple strikes out. So that's still not terribly risky, but you're increasing the risk profile, but you're also increasing the potential reward. And so you can, going to the mid-range, I think, is pretty safe most of the time if you have, especially if the market is declining, I think, or ascending, if you're in a bullish market. This is a bearish market, of course. And so, that was a pretty good spot. And of course, as you see, we make it there. So you could have exited when it was in the money, or you could have taken profit further down on reversal right there. But it basically stays there, and it's there for the rest of the day. So like, that's a good trade. If you got the 95 strike and you got in anytime here, that would have been a decent trade. So that's good. Now let's take a look at another example. Here's SPY. This is a bigger decline, but we also started pretty far down at the open. So, we were at 395-ish. Again, rejected off of that ribbon, rejected off of that mid-range level. A good strike selection here would have been 392. So the 392 put, which I have in my trades watch list, was a good strike, and you could have taken that. And so I actually have 395 and 392 on here because that's what I was looking at. I didn't trade on Friday, but that's what I had, and because I was looking at these levels. And so, if it had started higher, maybe I would have taken the 395 strike, and then, a little extra juice, no problem, goes -1 ATR. Since it started lower, looking at that -1 ATR level felt attractive. It's still $3 down from there, so that was a decent trade. So that's how you can kind of sanity check your strikes with these levels. Just take a look at the next level down, or an easy way to do it is, hey, I'm just going to buy whatever whatever in the money or at the money strike is at the call trigger or put trigger, and that's totally fine. It's a little bit less risk. You still have to manage your risk. You still have to manage your trade, and all good habits there. And of course, if the strike doesn't meet your risk profile based off of your P&L and the percentage of the P&L you're willing to risk on a trade, you don't take that trade. What you don't want to do is, you don't want to come in and say, oh, the SPY's going to crash, right? We all know it's tanking, right? We're all seeing it happen in front of us. What you don't want to do is, okay, it's been staying steady at this level. I think it's going to go to 380. Well, what's the chance of it going to 380? The ATR, so this is the average true range. So this is the typical move. The last 14 days, it's moved on an average about $10, right? $9 to $10. And, we're opening pre-market at 401.50. So, $9 down from there is about 392, which is, what our -1 ATR is, right? So, the chance of it going further, there's a possibility. There's always a possibility things can go further or higher, if there's news, or if there's some sort of macro event, or, there's a big sell-off or massive move to buying something. But on average, the probability dictates that going any further than that, it's going to be tough. It's going to be tough on any given day. And so what you don't want to start doing, if you're not just quickly trading these strikes, if you plan on holding it longer and you're not scalping them and kind of just catching a piece of the action on a far out of the money strike. And, generally too far out of the money is just dangerous. Those are sold, cheap for a reason. Most people will lose money on those. 95% of the time you're going to lose money. If you hold on to those, you have to trade them quickly. But to sanity check it, there's really just no point. 380 is it's very unlikely. In fact, if we turn on our extensions lower, right? Let's turn on our 2 ATR extensions. Okay. So I've got 2 ATR extensions on here now. We went down to the first extension level. That's the 1.236 extension, right? You can see it's acting as support. And now, if you were wondering what was that level that we were looking at, why was it staying there? Now you know. So that's the power of these extensions, especially in the current volatile market. Having those extensions on can be helpful. But it's hanging out just at the first extension down, and bouncing between there, and it's not really going to go further. So maybe you could have selected a 390 strike, but that's really risky. The chances of it going further than that, or further than 392, are bad. And instead, what you can do is, let's say we started at the pre-market previous close, right? You could have gotten a strike at 400, a 400 put, and then maybe when it moves down here to 395, if you still feel confident it's going to go lower, you could roll down to a 395, right? Take some of your profits from your 400 and roll it to a 395, get some more juice. Or, let's say you're further out of the money. You started at 395 and it was at 400, went to 395. Then you can roll it out to, let's say, 392. If it gets 392, you can roll it out to 390 with profits, with your profits. And, so rolling is probably a better strategy in that case than just picking a far out of the money strike because it's cheap, right? Because, 382 would have been 2 ATR. And we have seen 2 ATR moves. But after the sell-off from yesterday, it would have been really a lot more than 2 ATR move. Or if we look at, let's say, our multi-day, levels, we're already, we gap down. We're already at -1 ATR on the weekly levels, right? On the multi-day levels, which are weekly ATRs. So that's again, this is 392. So there's a lot of confluences here. So using different, and let's take a look at the swing levels, right? The swing levels, 392, again, is popping up as an important level. So, there's ways to use these levels and you should use all of them. Let's look at position. Position is saying, 387, is possible, but it's not going to happen in a day. So you can sanity check that against your day levels. But we're kind of in that range, so it's giving you a nice sanity check on what's going on. But really, these day levels, if you can do day trades, you can use the level that you're at. You can use the next level down. Can be a good possible. You can do something in between if you want. Going further than 1 ATR in either direction. Unless you have a thesis that's based on some incredible macro, some news, something, it's pretty unlikely it's going to hit beyond that. It's very, very uncommon for that to happen. It does happen. And of course, it can be high reward if it does happen and you're right. But, you're better off, ideally you want to buy something in the money if you have big count or at the money. And if you're growing your account, out of the money is helpful because you can deploy less capital to make higher gains. But sanity check it with these levels. And I hope this is a helpful video. I know strikes and expirations are kind of a difficult thing. And maybe this will help you kind of understand how to pick your strikes. Nothing is perfect. Sometimes you may select a mid-range level and it never gets there. It gets defeated somewhere in the middle. Some news comes out or whatever. So still, please manage your risk. That's very important. One other thing before we go, let's talk about expiration. So we're talking about day trading. What if you're, swing trading? Same thing here. So I actually was bullish for a little while on S&P 500. I really thought we were going to get a technical bounce up to 420, 430. Where I got 420 from was this call trigger. So I was, we were hovering in this range and I was looking for a move by monthly expiration to 420 and then possibly a rejection back down. So that's how I picked that strike. And we were pretty close. I think we were at 415 and, I got it when we were around 410, which is a $10 move on a daily basis. On a weekly basis, we move, somewhere to about double that. So it's typically a 2 daily ATR move on the week. And so I felt that was a good strike, especially if we had a breakout. And of course, there were a couple of trades executed on that where I made money. And then I was stopped out on this move to the downside. But picking a strike into the downside, again, you can say, hey, where are we? We're still at the previous close, which is about 410. So that was the weekly close last week. We're at 410. We're hovering here. We broke down the put trigger. So at that point, you could have said, okay, well, what's going to be a typical move in the week? It's going to be, $18, $19. But, a daily move is $10, right? $9. And so let's go back to our multi-day. We're declining here. It is possible we go all the way to the bottom, but the safer strike would have been, let's say 400. Right? Here's 398, so probably high liquidity would have been 400, and that would have been fine. So as it broke through this put trigger and it had broken through the put trigger on the daily levels, you could have bought a 400 put and taken some profit on it. On Thursday, and then of course you would have woken up to some nice gains on Friday. So that's how you can kind of sanity check an overnight swing or a swing, during the week. Same deal with swing levels, right? We broke through that 405 level, which was the, short trigger on swing levels. This is a daily chart. At that point you could have said, okay, 392 might be possible. That's pretty far, but if you're holding it for, let's say 2-3 weeks, yeah, not a big deal. And of course it would have hit the next day. Better would have been, using these multi-day levels. I think 400 was really the right one. And you were still at 405, so it would have been a decent pick. So that's kind of how you can sanity check. And again, you can use the rolling, you can roll your contracts. You don't have to hold the same ones all the way through. Of course, that's fine too. So that's my video on sanity checking strikes and expirations. I hope it's helpful.